All right, everyone, we're going to go ahead and get started. Welcome again. My name is Kira. I'm part of the team here at Richmond Brothers, and on behalf of our entire team, we just wanted to say thank you so much for joining us tonight. We know that any given night or time, there's lots of different things that are going on, and so we are very grateful that you're here with us on this gorgeous evening. So before we dive right in, just a quick note. We do have some disclosures to go through. So everything that we're sharing today is for general education. It's not investment, legal, or tax advice. We'll touch on different financial strategies and tools, but we're not recommending anything specific for you personally. Our goal is simply to give you ideas that might help you work towards your goals. Just keep in mind that all investments involve risk and we can't promise any outcomes. If you have tax or legal questions, definitely check in with a qualified professional. So at this time, I'm going to go ahead and turn it over to one of our presenters tonight, which is our CEO and co-owner, Matt Kirkman. I know there's some of you in the room that might not be familiar with Matt. There are some trifolds on the tables if you'd like to learn a little bit more about him. But Matt is a born and raised Jacksonian. He's a husband. He's a father to his pup Oliver, which you may see a little bit later. And he is just a down-to-earth leader. He is super passionate about helping people learn about really complex financial topics and just making them super simple to remember. So without further ado, I'm going to turn it over to Matt to get us started.
Thank you, Kara. It is so nice to see all of your smiling faces on this beautiful spring/summer day. I heard some people were actually golfing before they came here, getting out to enjoy the weather. But this is a great venue. This is a great topic, given all of the uncertainty that is happening in the world and especially in the financial markets, which ties into portfolios and investments and income planning, all these things. So as we kind of look into tonight, Kira kind of laid a little bit of groundwork here. But when you think about a complete, just overall retirement plan, you know, we kind of look at it in 5 different pillars. And for those of you that can't see in the back, income planning, legacy planning, healthcare or Medicare planning, tax planning, and investment planning. And so tonight, we're going to actually just take this one pillar over here, the investment planning, because that's causing or it's creating the most noise this year. And the one thing that any market does not like, and I'm talking about all the stock markets and all the volatility, is uncertainty. And raise your hand right now if you feel very certain about where things are going and you have a path. Because if so, I want to talk to you after. And I want to get some tips. And Dan and Mitch here from Beacon want some tips as well. I say that sarcastically, but the point is no one really knows where we're going, what's going on. There is a lot of uncertainty. And so this was a really great topic that we wanted to bring to all of you, and we are going to record it. There is a lot of hoops to go through from a compliance standpoint in language that we use and how we talk. So if you have friends who are interested in this, we're probably going to have a stripped down version, but with a lot of the content that will be available, but it won't be available tonight. It may take a couple of days to go through our compliance department, but that is for everyone's benefit. We don't want to put information out there, and like Kira said, we're not putting out a recommendation. This is educational. And in general, you know, I grew up in the days, I started at Richmond Brothers in the 90s, just a couple of years ago. I turned 45 last month. My biological age, when I get my blood work done though, still says I'm 34. So I'm very, very proud of that. So the point of it is I want to be around a long time to help lead the company and be the chief energy officer, not the chief executive officer, and help guide you guys through all of this chaos and craziness that's happening because you're retired and generally income's not coming in. And we need to say, look, how do we have a sustainable path that we can feel comfortable and confident in? And, you know, we are honored to be there to help walk you through all of this. So everyone know Oliver? Anyone not know Oliver? He has to make it in every one of my presentations. And if any of you have seen some of my Matt's Minutes videos that come out, we try to do it once a month, but actually more recently, it seems like it's every other day or every week. because every time I look at my phone, I look at headlines, something else crazy is happening that's impacting markets and uncertainty. But I just put Oliver in because, sometimes in our world, everything is very serious and it's very impactful, but, we have to be able to smile through it. And so Oliver, for me, when I'm at home, if anyone can see these lights on my chest, these are one of our microphones. On my camera at my home office, the light's blue, and whenever it comes on, Oliver knows it's like video time. He comes running in the room and wants to be on camera. So, I've trained him over the last year, so now he knows and he loves being on the videos. Truth be told, more of you watch the videos when Oliver is in them, because the rest of the content doesn't really matter. No, it does. It does. But, dogs and pets, maybe kids, maybe grandkids, maybe golf, maybe hobbies, they soften some of this heavy stuff in life. So Kira found this slide, and it pretty much represents, it's a twisty, turny roller coaster, optimism, terror, uncertainty, fear, tariffs. I thought it was a pretty good representation of what we've seen since February that is impacting the market and impacting investment. So the topic we're talking about tonight, we were fortunate to have two representatives from Beacon. One is in Pensacola, Florida, Dan Baccarini, and then one is actually in Grand Rapids, Michigan, Mitch Mellon. And I have done a lot of work over the years in trying to find solutions for all of you that isn't always just going to be a buy and hold and ride through, you'll be okay. Because when you're retired, the fact of the matter is we're not adding to the pot anymore. And we have a set amount of dollars that we're trying to create an income stream. And the other big unknown for all of us is how long we're going to live. We don't know how long we're given. Therefore, we don't know how long our money needs to last. And that's a pretty important factor with the planning that Richmond Brothers and all of our team help you with. And it's an unknown. So add that on top of this roller coaster, it creates quite a puzzle when you go out there and say, what are all the investment options available that we can offer to you? And so I thought that was an interesting thing. So one last slide, and then I'm going to turn it over to our keynote speaker. How can you feel confident when markets get rocky? And in general, just take a step back, take a breather. You've heard this a little bit in my Matt's Minutes, but very simple, very simple. Look and say, okay, do we need to rebalance? So do we have the right allocation? If we're moving too much in the portfolio, or you feel it's moving too much, call us, email us. Maybe we need to rebalance. Maybe we need to adjust your allocation. Okay. So simple action step we can all look at and consider. Refocus. There are so many distractions and there is so much noise. It is almost unbelievable. I had planned a personal vacation, which usually is piggybacked off of another work conference where I'm trying to go around the country and meet up with other advisors, other investment analysts, and trying to figure out, are we in the right place? What's next? What happens in the next 5 years for my clients? And in doing so, literally, this is when I was doing a Matt's Minutes every other day a few weeks ago. And then the day I was actually supposed to fly out, another major headline came in. Anyone see the one where Oliver had torn up his octopus, like all the stuffed animals all over my office at home? I kind of joked that he was tired of all the headline noise as well. There is a lot of distraction and there's a lot of noise. And with everything being online, just remember that headlines sell. The more clicks you get, the more the journalists, the more the people. No, it's not bad. We need to get information, but headlines sell. So every headline, the headline is more extreme than it used to be, in my view. And so again, try to just eliminate distractions. And then lastly, reassess your long-term goals. Have your goals changed? And if they haven't changed, we go back and say, do we need to rebalance? Are these things still working for you? It's never going to be a perfect path, but we also don't need this. Okay. So I just want to kind of set the stage. And then next, I'm going to introduce Dan Baccarini. He is the Chief Distribution Officer. He goes around the country and he works with institutions. So think like broker dealers and big firms, whether it's a Fidelity or Charles Schwab. And then he also works with individual offices like Richmond Brothers all around the country, just to help educate the investing public on options that are out there that could be considered for retirement. I have heard Dan speak probably no less than 5 times. And every time I've heard him speak, he has a passion that is unparalleled for education and on this topic. So I think you will really enjoy him. So I will bring up Dan, and then Dan and I will be on stage after, if we have time, and I think we will, for some questions and answers. Does that sound good? All right, thank you all for coming out, and Dan, come on up.
Here you are.
Thank you so much. Appreciate it. Appreciate it very much. I'll get this thing right. My mug.
There we go.
Today at lunch, Matt was telling us about his tests, his health tests about the biological age, and so he texted it to me. Hey, you have to check it out and try to do it. I'm kind of nervous. Like, what if my biological age is like, oh, you're you're getting close, guy. I'm worried about this. So I don't know if I'm going to do it, Matt, but we'll see. So anyway, my name is Dan Baccarini with Beacon Capital Management. Been with Beacon for 14 years. Been in the financial industry since '93. So I've been in it a while, like Matt has. And it's a pleasure being here. I've never been here before. But I work all over the country. We have over 1,000 financial advisors that work with our firm. We have over 10,000 clients with about 40,000 accounts. So I get to see a lot of stuff out there. And I will tell you this before I get started. What Matt and what Richmond Brothers do for you guys, for their clients, is it's not normal. It is way above what most people do. Again, I work with over 1,000 advisors with our firm, but I consult with hundreds of advisors every year. So I know what's going on out there. I know what the top people do, and what is being done with you and for you is above and beyond. It just really is. You may not realize it, but it is absolutely incredible. But anyway, so today you're going to hear a little bit about Beacon. But really, I hope you're going to get some nuggets. You're like, wow, I didn't know that. Or wow, that's unusual. So today we're going to talk about solving your number one question as it relates to financial planning. And what is that question? It is, am I going to be okay? If you think about it, the very heart of retirement planning, financial planning, is just trying to answer that question. Am I going to be okay? There's lots of am I going to be okays. There's, am I going to be okay right now with all that turbulence, that roller coaster, tariffs, all the uncertainty? Am I going to be okay during my retirement years? Is my money going to last? Matt kind of touched on that. Am I going to be okay if I became disabled? Or my heirs, are they going to be okay if something were to happen to me unexpectedly? There's lots of am I going to be okay? The very heart of what Matt and his team and Richmond Brothers does is really helping you answer that question in the affirmative. Yes, you're going to be okay. So today we're going to talk about two of those am I going to be okays. They're the most important am I going to be okays. Survey after survey shows this is what's on most investors' minds, most retirees' minds. So the first am I going to be okay is, am I going to be okay right now? We know that the markets, the economy, there's so much uncertainty. But what we're going through right now is unfortunately not unusual. Bear markets happen about once every 6 to 7 years. We've had two in the past 5 years, 2020 with the pandemic and then 2022. So they're starting to happen more frequently, and they average down almost 40% each one. So worrying about the market is not unusual. Right now, there's a lot of uncertainty, but all bear markets have uncertainty and certain issues that are underlying. But the main issue is this. This is something you may not have ever heard of. It's called systematic risk. Systematic risk is the risk inherent in the entire market. You can't get away from it. Right, like a good example, March 2020, which was the pandemic. It didn't matter how you were invested. When March 2020 hit, you were going to get hit hard. Maybe not as bad as the market down almost 40%, but you're going to get hit hard. That's systematic risk. Systematic risk, you can't diversify yourself out away from it. In other words, diversification doesn't work at this time frame. Systematic risk is like 2020, 2022, 2007, 2008, 2000, 2003. So tech crash, financial crash, COVID, those are systematic risk issues. Now, the problem with bear markets, the problem with systematic risk is math. So this, I hope, is one of those education pieces. This is probably the most important thing you're going to learn from me tonight, is the math of losses. Here's the statement. This is the punchline. Then we'll start going to some examples to really emphasize it. Losses have a greater mathematic impact on portfolio results than gains do. So we're just going to show an example first. If you lose 50%, you don't need 50% to get even. You need 100% because the losses are more impactful. Let me show you another example. I'm going to give you two here. If you had, oops, back up there. If you gained 50% this year, and you have $100,000, and you lost 50% next year, that's 0%. How much money do you have? How did you do? Most people think, well, I up 50, I down 50, I'm probably breaking even. No, you actually lost $25,000. You're down 25%. Why? Because that loss, is more impactful than that gain. Here's another one. You have your two investment choices, investment A and B. Again, $100,000. Investment A, we get up 60% this year, down 40% next year. So over 2 years, that's 20% divided by 2, because 2 years, equals 10% average a year. Investment 2, or B, it's up 10%, down 10%, 0% over those 2 years. Most people go, that's better. It's not. You think it would be. The return sounds better. You actually end up with $96,000 here and $99,000 here. See, almost every person out there will go, I'm willing to give up that 40 because I got that 60. Not realizing that the 40, the down, is more impactful mathematically. We don't realize that. A lot of people think, if I lose this, I'll gain it back eventually. Well, there's two problems with it. One is the math. It's hard to gain it back. But the most important thing is the time. When you're 35 years old, you've got 30 years in the future to gain it back. When you're near retirement or in retirement, you have 0 time. So you cannot afford this, which gets us into the number one concern that everyone has. What's the number one, am I going to be okay? It's this. Will my retirement income last? Right? This is the money question. This is what Matt does for a living, is to get you along your financial journey into retirement years, and then your money lasts as long as you need it to last. Speaking of how long it needs to last, here's a little statistic. If a couple hits 65 together, there's a 50% chance that one's going to hit 95. There's a 25% chance one of them's going to hit 100. So back when I got in the business, we always just talk about retirement was a 20-year thing. It's now a 30 to 40-year thing. So your money needs to last longer. And in the distribution years, in your retirement years, the math is slightly different. If you think about it, if you're taking out 5% and the market goes up 10 and you're taking out 5, you only made 5%. So your gain is weakened. If you're taking out 5% on the flip side, if you lose 10, you didn't lose 10, you lost 15%. So your loss is magnified. Look at this math. This is, I think, should scare you to death, but there's a solution. So I'll scare you to death, but no, there's a solution. So you got $1 million, and you're 65 years old, and you're going to retire in something called an 80-20 portfolio. I'm going to explain what that means. That means 80% of the portfolio is in stocks, 20% of the portfolio is in bonds. That's all that is. Right? It's kind of a balanced portfolio, sort of. and you're going to withdraw 5% a year because you're in retirement, you're 65 years old. If you retired in 1975, your money lasts for 30 years and your retirement's fine. Am I going to be okay? The answer is yes. If you retired 1 year earlier, 1974, your money runs out in 13 years. A single year. Why? Bear market, 1974, down 26%. See, a lot of people think that I can survive, it may hurt my retirement, but I'll be still okay. A bear market, the reality is, if you have experienced a bear market at the wrong time in your financial journey, basically if you're in retirement or near retirement, it's not a speed bump, it's not a hurdle, it's ruinous. It's not a good thing. It's bad, really, really bad. So almost the number one objective isn't to get these 60% returns. It's to avoid the catastrophic. If I can avoid this down 26, I don't need to try to get the up 60s, which is a really important mindset for you to understand, because we want to start putting math working in your favor as opposed to against you. So what is the solution? How can you deal with this stuff? So there's really 3 steps to this solution. Step 1 is maximizing diversification. And we'll talk about each of these steps in a little bit of detail, not a lot. Number 2 is that avoid the catastrophic. Are you going to completely eliminate losses? Absolutely not. You can't. You're going to still have some losses, but we don't care. As long as we can keep it within reason, as long as we can avoid the catastrophic, we'll be okay. And then number 3 is maintain discipline. We actually have a picture of a roller coaster. It's almost the exact same as what Matt showed earlier, so it's kind of interesting. But I want to steal that roller coaster picture because that's perfect. So step 1 is participating, but participate correctly. So let's talk about, this is another really important point, I think you all need to understand, because the headlines that we hear of the market is the S&P 500. But there's something really important to understand about the S&P 500. The S&P 500 is not a well-diversified vehicle like we think it is. We think, oh, that's the market. That's all the top 500 US companies in the country, which it is. But it's not equally weighted. In fact, it's market cap weighted, which means the largest companies have a greater impact than the smaller companies. So right now, the S&P has about 40% of all of its weight, all of its impacts coming from technology. As a matter of fact, there's about 10 stocks that make up about 50% or 40% roughly of all the impact of the S&P 500. Here's a tidbit. Apple, one company, has a greater impact on the S&P 500 than the entire real estate sector, meaning all the US real estate publicly traded companies and all of the energy companies in the US that are publicly traded combined. So you combine all those real estate companies, all those energy companies, Apple has a greater impact. So really, it doesn't relate to what most people need or what most people want. Here's another thing that's important. A lot of people look at the S&P and use it as a comparative. In other words, oh, look, the S&P's up 32, I'm only up 13. What I always say to that is this. How many in this room are okay if your investment goes down 50% next year? No, right? Is that good? How about down 50% twice in the next 10 years? Oh, heck no. But that's what the S&P 500 has actually done. I'm not saying it's going to do it in the future, but that's what it has done historically during the 2000s. Went down twice, over 50% in that decade. So that's not a fair comparative, because while the S&P may be up all this, it's also down all this. And the down is what's impactful. So you gotta, it's so hard because that's one of those noises in the marketplace or out there that we're getting bombarded with is the market's doing this, the market's doing that, it's not a fair comparative because it's not what you guys are really trying to do. You're not trying to get the up 40s because when you try to get the up 40s, you're going to be vulnerable to the down 40s. And that's more impactful. So what do? We simply break apart the S&P 500. It's already broken apart this way into 11 sectors. What a sector is basically the different parts of the US economy. So it's like utilities, industrials, energy, healthcare, technology, etc. It's all just the US economy, and we equally weight it. So we're not trying to take a bet on a big sector. We don't want to put 40% of our money in technology. We want to just equally weight it so we can participate in kind of a smoother ride. Now, why do we use sectors? Because when you're building a diversified portfolio, a well-diversified portfolio, we're using building blocks, right? The little investment pieces, so in our case, sectors. You can't have those building blocks doing the same things at the same time for the same reasons. They got to do different things at different times for different reasons. And we can measure that mathematically. And what we know is mathematically, sectors do things at different times for different reasons because they're like little independent economic units, right? You have energies doing things based on like big things going on in the Middle East and all over the world. Healthcare doesn't care about that stuff. Based on domestic policies, utilities are totally different than financials. They all do different things for different reasons. The perfect little building blocks. Why do we equally weight it? A lot of people ask us that. Wouldn't we be better if we just put all our money or a lot of our money in technology or something like that? I'm going to explain this chart. You're looking at it right now going, oh, there's a lot of colors and a lot of squares. All that is simply doing is looking at all 11 sectors ranked from best to worst every year. So if you're at the top, you're the best sector. If you're at the bottom, you're the worst sector. I'm going to just show you an example of trying to outguess the market. I'm going to use utilities because it's red. It kind of stands out in this chart. Utilities is the worst sector and second worst sector 2 years in a row. So most people will be like, let's get out of the utilities. Don't want to have anything to do with it. Next year, number one. Now we need to put all our money in utilities. It's obviously the best bet. It's the bottom again. If you look at any of these sectors, it's the same way. They're all over the place. They're at the bottom, they're at the top, they're down here, they're up there. But look at the white. The white is the equal weight. Look at the smoother ride that you get. You're never going to be up here, and we don't care. We don't want to be up there because we're never down here. And mathematically, this is more impactful than that. Avoid this, and you don't ever care about being up here. You don't ever want to be there because when you're there, you're vulnerable to there. So that smoother ride, this is what we call our first line of defense. Just smoothing it out a little bit, just based on our allocations. Now, this is where a lot of people kind of part ways. A lot of investors and a lot of financial advisors, peers of Matt's, and those here at the company, they believe in asset allocation. They believe in investing. They believe you should be in the markets. They believe in buy and hold, which I think is almost like a buy and hope. You're hoping the bear market doesn't hit because the bear markets will hit. Catastrophic losses, bear markets are not if events, they're when events. It's not if it's going to happen. It's just a matter of when it is going to happen. It's going to happen. It's just when. And the bad thing is we don't know when. And the key here is to plan for the catastrophe before it happens. You can't plan for the catastrophe once it's happened. It's like insurance. You don't buy insurance on your house after the fire. You buy it before the fire. Do you know what's going to happen? No. And in that case, it's not even an if event. It could be an if event. You don't know. So in this case, you've got to prepare for the catastrophe before it happens. So what do? How do we avoid that catastrophic loss? That's the key, right? This is how we're going to start putting the math in our favor. We did the equal weighting. That was step one. Step two is now to avoid the catastrophic. What do we do when the systematic risk hits? What do we do when it all goes uncertain? We prepare in two different ways. The first way, we're using something called a trailing stop loss. What that means is, as the portfolio is growing, we keep locking in the gains higher and higher. So it's going up, we keep locking in those gains. Last year, 2024, we locked in over 40 new highs in that portfolio. Those portfolios going up, we just keep locking in those gains. If it closes down by 10% or more from its most recent loss, or most recent high rather, we're going to sell out and move into fixed income. So this is like where we're normally allocated. This is fixed income. And then we're going to monitor it daily. When it shows a real rebound based on math and history, all formulaic, we're not using guts and guesses. We're not trying to outguess the market. We're using math and history. When it shows that it's showing a real rebound, we're now going to move back into the normal allocation. It's all in, all out. That's one way we do it. The second way is we're now looking at the strengths and weaknesses of each of the individual pieces in that portfolio. So instead of looking at the whole portfolio, we now look at each piece. So if, in the case of the sector portfolio, if utilities is showing weakness, we'll sell out of utilities and keep all the rest in. And we'll move just that piece into fixed income. We don't put more bets on any other sectors. We don't like overweight anything. We're just going to move out of the weakness and let all the strength ride. When it shows strength again, mathematically, we'll buy back into that sector. What's the beauty of this risk management overlay is it's very flexible. So we can do this with all these sectors. We can also do it on other components. We can look at the S&P 500 and the NASDAQ, two big market components. And we can overlay the risk management on top of those. So while you don't want to be in the S&P unprotected, how about you can get a little bit of exposure to the S&P, but have the protection from the catastrophic? That's the best of both worlds. And we can do that with the NASDAQ, which is a little bit more tech heavy. So now you can have all these different risk managed diversification components in your portfolio. Each one is reacting slightly different than the other. They're getting out for different reasons. They're getting in for different reasons. So instead of just being diversified with your underlying holdings, with your different sectors or different mutual funds, now you can be diversified with your risk management strategies. Because everyone works a little bit differently. Some work better sometimes, some work better other times. But when they're working together, now you're going to be able to cover for all the different market possibilities out there. Step 3 is maintain discipline. This is, while protecting the losses is extremely important, this is just as important. Because we're human beings, and we deal with that slide that Matt showed. We deal with this, the roller coaster of emotions. I've always said, I think a lot of the decisions we make as human beings, the bad ones we make, are emotional decisions. We're buying stuff emotionally, we're selling stuff emotionally, we're getting relationships emotionally, getting out of a relationship emotionally. Same with the finances. The market's up, we're great, let's put all our money in. Market's down, we gotta be out, and never know when to go back in. You know, they said that after the financial crisis, so 2007, 2009, that the average investor that moved out didn't move back into the market for over 5 years. The market went up over 70% over that 5-year time period. But most people didn't even go back in. They were too scared. So you've got to use a process that's based around something. We base ours around math and history, where some people try to base it around guts and guesses. It's kind of your choice where you want to go. And that is really the choice. As investors, we all have choices, myself included. I can ignore volatility, ignore bear markets, ignore systematic risk, ignore math, ignore the catastrophic potential, or I can prepare for it. And you can't prepare for it in the catastrophe or after the catastrophe because it just doesn't work. A lot of people, most investable dollars in the United States right now are in retirement or near retirement. They have zero time for error. They have zero time for bear markets. They can't. It just doesn't, you don't have the time anymore. So you've got to have some sort of plan in place. Whatever it is, and I know, I mean, I've known Matt for a while, so I know there's other things that he does besides us even that are still in the risk managed bucket of trying to help. How do we solve this puzzle? Because that's what it is. It's a puzzle. And luckily, you know, you have someone that is always looking at different ideas and brainstorming with us and brainstorming with other experts in the industry, which you're fortunate, like I said, to have someone that's leading the charge in that way. So that's all I really have. If you have any questions, please feel free. Matt and I are right here. And I'll also be lingering afterwards. So if you have any questions, just offline, talk, chit chat about anything, I'm more than willing to chat.
Thank you.
I just stay up here.
Testing. There we go. Thank you very much for that passionate display of math. So did everyone, or at least the vast majority of you, learn one thing new or one little more tidbit as far as whether the strategy or how you approach the market or what the S&P 500 is or what cap weighted, meaning concentrated, versus equal weight? Did everyone pick up just a few things like that? It's really, really important when all we're fed are headlines and noise. Okay, and you have to know what's a good resource to get educated and get informed. As Dan said, it's not that these strategies are perfect, but we don't need them to be perfect. We need to do our best to try to help avoid catastrophic loss, and catastrophic loss we're defining as bear markets. And so from Richmond Brothers' standpoint, if you do go back to that 2020 period, and you remember we talked about 2022, talked about 2020, you go back to even the fall of 2018. It feels like a lifetime ago. But in the fourth quarter of 2018, there was a lot of headlines, and it was a really, really poor quarter, really, really negative. And so we were starting to see trends develop that it's possible that negative downward trends are happening at a faster frequency and in closer timelines. And if that happens and you're retired, that concerns us. So it took a couple of years to just go out and look at all the different options, come across a company like Beacon, and that's just a little bit of the background. We don't know where the next 2 years, 4 years, 5 years, 10 years are going to go. Will markets grow over time? Probably. They always have. Do we know what they're going to do in any given quarter, any given year? Do we know that, you know, today, let's say today is the turning point for the market, and at this day for the rest of the year, the markets just grow. What's our risk? Is that we're going to miss a little bit of that bump while we let things stabilize. And remember, eventually those algorithms that are historical and mathematical based kick in. But if you didn't lose excessively when the market lost excessively this year, you don't need that huge jump. Does that make sense? So the math is really, really important. We're not trying to get back into math school, but it's really, really important, and it solves for a lot of these puzzles that we try to help you work on. So let's just take a few minutes. I think we have, yeah, it's 7:14, and we want to get you out of here by 7:30. So any direct questions while we have the math whiz here himself? And if it's Dan or myself, we'll be happy to answer. There's got to be at least one. Go ahead. And I'll repeat the question.
With communication being so important in our world, and the fact that things that happen in Europe can affect our markets, or things in our market can affect the rest of the world. Like the stock exchange, New York Stock Exchange, a few weeks ago dropped 3,000 points. Okay. I had a friend that said, boy, I must have lost a lot of money during that time. I said, yes, maybe. But if you're in the market long term, maybe it's not such of a problem. But he's retired, and he's worried just like we are about our financial stability when things progress. But then the following week, okay, we had 2 days in a row where the market went up 1,000 points. So I'm thinking to myself, maybe what I was telling you isn't so bad. But what do you guys think about it? What is
Dan, do you want to paraphrase?
Yeah. So
And then
the question again was basically the market went down a ton, a bunch in 2-3 weeks ago, and then it's had some days that it's gone up a ton several days ago. So what does that all mean? Well, what it means is we don't know, and that's the problem, right? The uncertainty right now, the volatility that we're experiencing in the market right now is just, I mean, the past month is just absolutely crazy. I mean, if you think about it, we had days where the market moved 10% down in a day. We had markets where it moved 8% during the day, up 4, down 4, so 8% moves. Another day is up 10%. It's just absolutely insanity. And it is a lot to do with what you're saying. The world is, the communication, we're kind of being one much more than it ever has been before. So that is really the point of like our strategy like ours, is we have to step back from the noise and don't let it affect us. Let the markets do what they're going to do and let the math work itself out. That's what we know. We also know during times of high volatility, every bear market that we've experienced has high times of high volatility like this. Very rarely do we have markets of this level of volatility that don't eventually tip into the bear market. We actually, this market, the NASDAQ has tipped into a bear market. The S&P 500 almost touched it intraday earlier this month. So we've gotten very close to it. So I don't know if it's done or not. That's kind of the nice thing. We don't know. We know the markets can either go up or going to go down or go sideways. Either way, all three of those, we have a plan for. And it's already set in place, so you don't have to think, okay, now what am I going to do? Now I'm going to go in? I don't know. Let the process work. But the problem is the noise. And that's, I think, really what Matt started with was the noise of uncertainty. It does, absolutely. That roller coaster we were talking about. Yep.
And just thank you for that. And a great question. So another perspective, if you didn't catch this earlier, what is a bear market? It's a drop of more than 20% from the most recent high. So if you think back in the last month and a half, he just said a bear market happened in the NASDAQ, and that is mathematically true. So remember the day where there was a couple of big days down, then there was a day up, and we even got some calls that said, did I just miss out on the best day in 25 years because we're sitting in the fixed income allocation? And we looked at the math, and the hard truth is, if you didn't drop 25%, you didn't need that day. And even after that day happened, I looked at the NASDAQ, and we'll have to quote the exact numbers and get you this, but after the jump, it was still negative 14% after one of the biggest one-day jumps in 25-year history. And so that didn't say that in the headlines, did it? It just said, oh, the biggest jump since I think 2001, I think was the headline. But again, if you wrote that all the way down because you didn't have a plan in place, you might have needed that day. But even after that day, it was still negative nearly 14 or 15%. And so that's the hard part. Dan and Mitch, he's got Mitch in the back. We were talking at lunch today about how are clients feeling and how are we communicating. And so we talked about Matt's Minutes videos and just trying to put that guidance out there. And we said all three of us agree that in the middle, it is so crazy even for us because we don't know. And trying to help guide you through. But to his point, there are three things that can happen. And these strategies have a plan for all three things. The unknown is which one of those three and when. That makes sense? Great question. Thank you.
Yeah, it's a really good question.
Any other questions, thoughts come to mind? Oh, go ahead. So Lisa asked how the system calculates when to get back in.
So there's two different overlays, right? Because there's the one that goes all in, all out. And then there's the one that is looking at each individual sector or each individual piece. So it's maybe a little bit of a technical question, but I'll answer it. In the all in, all out, what we're looking for is the rebound from the bottom. So the longer it takes to get to a bottom, so in other words, the longer the bear market lasts, the more confidence we're going to need for us to get back in. And we measure that level of confidence mathematically. So we're looking for a specific rebound percentage based on how long took us to get to the bottom of the market. So it could range anywhere from 15% to 25%. So like if we look at the bear market of COVID, we hit the bottom very quickly. So we only needed about a 16% roughly rebound from that bottom to get back in. So we got back in like April 1st. But the big bear market of 2022, we're out of the market for about a year or so before it finally bottomed out. Now we need a higher degree of confidence to get back in. So we just know that as bear markets last, it starts really taking a toll on our psyche. And so we get a few more what we call bear market rallies, fake rallies, and we want to avoid that. There's a great stat. I don't know if I have these numbers exactly right, but during 2007 to 2009, we had 6 rallies of 8%. We had 3 rallies of over 10%, while the market was going down 57%. So what we don't want to do is get caught up in these little fake rallies that happen. So that's why we have that rebound a little bit higher, because we want to make sure we have real confidence to get back in. The other one is just based on where do we think the other risk management overlay like we have on each individual component. That one we're looking at the strengths and weaknesses for each component. And we measure that mathematically again. We're just looking at where should, let's say, utilities, where should that move on a normal basis? At the top of that range we call that the bull trend line. At the bottom is the bear trend line. If it shows weakness by breaking below, we sell. Shows strength by breaking above, we buy. And every one of those is different because you have some things like technology that are very volatile, or more volatile at least. So we're going to have a wider range because it moves bigger. And we have things like utilities that are not volatile at all. So we have a narrower range. So we're going to have a little bit of a tighter range because it doesn't move that much. So that's what we do a little bit different in both of those. But again, we're measuring everything mathematically based on history. And where do we know mathematically have these things in the past moved? Is it perfect? Absolutely not. The first person that sells you something perfect, you've just been sold. There's nothing perfect. I mean, I wish there was because I'd be in it, but it's as good as what we can find, and we know over time it does soften the blows and avoids the catastrophic.
Great question.
Really good question.
And to tie into that from Richmond Brothers' perspective, when we talk about the different strategies that he mentioned, the all in, all out, the sector by sector approach, we find mathematically that it's good to not just choose one. One is not better than the other. We actually prefer to have a blend of those, both for when we're exiting and for when conditions get better, because it's not going to be everything out at once and everything in at once. Does that make sense? So that's a great question. So when you blend those two together, even within a portfolio or within an account, and again, this is not a recommendation. This is just a preference that we have when we look individually for all of you. We can manage that a little better so it's not so extreme on either end. Does that make sense? Thank you for the question. Go ahead, Jim.
What is the risk factor that you guys calculate that relate to the
So the question was, how does the risk factor that we calculate relate to the different strategies? So riskalyze, or nitrogen as it's now called, if you look at a scale of 1 to 99, 1 is the safest you can be and 99 is the most aggressive. The higher your risk score, the more choppiness, the more up and down volatility you'll have. The lower the risk score, think of like money in the bank or a CD or perhaps a treasury or a fixed annuity is a risk 1. If you broadly look at the S&P 500, remember the choppy pie chart that was cap weighted? That's between currently a 75 and a 77 risk, okay? When you then overlay those stop losses, so you avoid some of that catastrophic loss, when we model it, we often see the risk of the market from a 75 to 77 come down into the mid 40s or low 50s. So you can have that market exposure because you have the safety net. So it actually cuts the risk using that tool by roughly a third. Now, if safety nets kick in, remember from equities to fixed income, Dan mentioned, fixed income is much lower on the risk scale. So if you have exposure to the strategies now, and they're largely in fixed income, your risk score is a lot lower, which means a lot more stability right now. That makes sense? And so thank you for that question. The other thing we talked about at lunch is I like to use simple analogies. And some of you, in our office, we have that glass conference room up front. And so imagine 3 people are sitting in that room. And each of those 3 people represent one of 3 different strategies Dan just talked about. And let's pretend that in that room, it's called the market room. And ultimately, the goal is to always be in that room. But, it's got that glass wall. And let's say that Dan, myself, and Jessica, because I'm just looking over at Jessica, we all are in that room, and we all represent each strategy. And at different times and for different reasons, we are going to come and go from that room. But when we leave the room, we go into a 30-day cooling off period. So no matter what happens, these false bounces, we talked about blood work, it's kind of like a false positive. Go back and get another draw and let's see what happens. So you can stand outside the glass and look in, but the goal is to always be back in the room. We're only out when conditions exist that suggest we need to be out based on math and based on history. Does that make sense? And you can choose to only use one of those strategies, but then you're less diverse. You can choose to use 2. Even though we're kind of looking at the same sectors, it's fascinating how the blend of those can help even mitigate Lisa's question earlier. Thank you for that. Other questions? I saw another hand. Go ahead.
So looking at mixture stacks,
So the question is, can you have a mixture of stocks and bonds? And the answer is yes. There's a balanced strategy. There's a conservative strategy. The further you go down from market or aggressive, balanced, conservative, you have more fixed income. None of it, though, just for context, is individual stock. It's market-based, but it's mutual funds or exchange-traded funds.
talk about avoiding lows. Do you have any kind of target high range over time to make sure that
So the question, I'll pass this over to Dan, but talk about avoiding lows, but is there a metric on the high side that you're trying to aim for because of inflation? We've all experienced higher cost of living lately, which is another risk and mitigation that we need to plan for in retirement.
So there's not specifically a target per se, because we're not going to cap it. So you can get, we've had years that we're up over 20%, but we still have the downside protection. So you've got that lower risk profile that Matt kind of talked about, that in some measures is about half of what the S&P was, but the S&P was up 20% those years as well. So there's really no cap and there's no necessary target, because we're just trying to get as much as we can out of the market safely. That's the most important thing. And because again, mathematically, it's more important for us to worry about that downside and let the upside take care of itself. Because if we can avoid that, we don't really have to strive for as much on the top. And it's crazy when you think about like this number here, like this portfolio, like right away. I mean, most people are like, I'll take that that down 40 if I got up 60. That's a no-brainer. Versus this plain vanilla thing, but this is what works better. So you don't really, that upside, see, it isn't as impactful. It's all that downside that really does. So it's really, it's such a different mind shift when you start. And I didn't know this. 14 years ago when I got introduced to Beacon Capital, I had no idea that there was anything to do with this mathematic effect on portfolios until I was introduced to Beacon, and we kind of developed what we developed. I didn't know this, and I'd been in the business at that point. It was 93 to 2011, so 18 years or whatever it was at that point. So I had no idea this even existed, and I've been in the business. This is my business. So it's a very fascinating thing, and I would venture to say that 90% of financial advisors don't know about this. They just don't understand it. No, very few people teach this. It's just a except for the math guys. The math guys teach it because they're like, oh yeah, obviously that makes sense.
And Dan also has a background in psychology. That's his bachelor's degree, which actually goes really well with math and finance, believe it or not. Remember we talked about the roller coasters and all the emotion? It matters a lot when you're trying to help people plan with their retirement. So I forgot to mention the psychology degree in your introduction, but that's a very good compliment in this industry.
For sure.
So it is 7:30 right now. One more question. And,
I just want to know, is AI used as a control trying to
So the question was, is AI being used or was it used in developing this? Well, this was developed before AI existed, so the answer is no. But the answer is yes for the future. A lot of the stuff that we have on the drawing board, we were talking about it at lunch, is going to be AI influenced. It won't be reliant solely on AI, but a lot of the research, the stuff that you can do with AI nowadays in a research capacity is just ridiculous. And so I think it'll become more and more so. But the existing strategies they are right now, no, they were not AI developed. But future strategies, they will for sure be AI influenced.
Yeah, great question. And then one final comment on that topic is, remember we talked about the pie charts that maybe have a little more concentration in technology versus being the equal weight sectors. So AI might be something that we want a little more exposure to, but not without, in our view, that safety net that Dan spoke of. And so even that is a strategy that didn't exist in Beacon before we worked with Beacon to add that, and now they've rolled it out to a lot of other advisors. And because we do think AI is going to have an impact, not only on the markets, but on companies' ability to grow and get more efficient. And so that's a great double-edged question.
Yeah,
so
really good.
With that, I'd like to thank Dan and Mitch in the back from Beacon for coming to Jackson, Michigan. Thank you, guys. Thank you. And I want to thank all of you on behalf of our entire team. You saw our picture up there, but everyone from Richmond Brothers, if you wouldn't mind just standing and waving. We have a lot of our team here tonight. Thank you guys for being here. And we even have a little one. We have a little one. We're trying to educate the young ones, starting at 4 or 5. Thank you all for coming. If you have questions, our general email is questions@richmondbrothers.com. If there's anything more specific you want, just reach out to us directly. And then we are, like I said, we have recorded this, so we're going to try to put that through compliance. And that way, even if you want it as a follow-up to kind of go through and listen to, or someone who else needs to listen to it, or you think it'd be educational, we will have that available to you. So I thank you all for coming out and spending your evening with us. And you honor us with your presence. And we are grateful to have the opportunity to help guide you through retirement. Thank you.
Thank you.
Appreciate you guys.